information on how we can continue. And we also just wanted to let everyone know that we will make a copy of the slides available to everyone once the presentation is complete. So with that, I'm going to pass it over to Ken and let him introduce our speaker today.
Okay, thank you, Justin. Buddy Baker brings more than 30 years of experience in international trade finance to his current position as Vice President and Head of Global Trade Solutions Delivery for the Fifth Third Bank. Fifth Third is one of the 20 largest banks in the U.S. and provides a full range of risk mitigation and financing products for domestic and international trade. His professional experience includes earlier stints with Atradius Trade Credit Insurance, ABN AMRO Bank, Bank of America, Wachovia Bank, and the First National Bank of Chicago. He's a recognized expert in trade finance and makes frequent presentations for national associations of exporters, importers, bankers, and lawyers. He owns the consulting firm Global Trade Risk Management Strategies, which specializes in educational training. He has also authorized numerous magazine articles and books. Mr. Baker is actively involved in establishing national and worldwide standard practices for LCs. He participated in the most recent revision of the Uniform Customs and Practice for Documentary Credits, referred to as UCP 600. He also serves on the board of directors of the Association of International Credit and Trade Finance Professionals, a multinational association of export credit managers. I'd now like to turn the presentation over to Buddy to begin the webinar.
Okay, thanks, guys. And thanks, everybody, for joining. Thanks for your patience. I should have probably changed the date on that first slide, but we obviously tried to do this presentation once before and could not get the audio working. I was trying to do it off of a cell phone. So this is going to be a whole lot better as far as the audio connection anyway, because I'm sitting on a landline using a handset. Okay, so the presentation is very, well, I shouldn't say it's very, it is somewhat focused on exporting. So I'm assuming that the people on the line, I understand we have over 100 people who have registered for today's program, are either presently involved in exporting or considering starting to export. But a lot of the things that I'm going to talk about you can use domestically as well. So these are risk mitigation techniques and then ways to finance trade receivables, just being receivables for you know, when you're selling goods as opposed to other types of receivables like you've lent money out or something like that. So everybody on the line, I'm pretty sure, is selling goods, even if not internationally, you're selling domestically. So some of these, a good number of these structures can be used, like I say, domestically as well. This is actually, I mean, we're going to do about a 1-hour presentation. Hopefully leave about 15 minutes at the end for questions. The topic is a pretty broad topic. So what I want to let people know is that this is actually a sort of an extract or a high-level version of what's a full-day program that I usually teach in person. So doing it as a webinar is, you know, hopefully going to give everybody things that you can use, ideas that you can take home, things like that. But I do want to let people know that I will be doing this as a full-day in-person seminar. I'm going to be doing it in California probably in March, and then in New York maybe around April or May, probably May in New York. So if you're interested in doing that kind of a program, let me know or let the Federation know, and they can pass the information through to me. And even though it's a full-day program, it's actually the third day of 3 full-day programs. The first day we go through just risks, so I want to give you a basic idea of the risks that are involved when you export, because the financing that's available to you is often based on what the risks in the transaction are, the financing being a question of finding a third party who's going to lend you money, or depending on your needs, we're going to get into this, but depending on your needs, maybe you just want to sell receivables, so you generate receivables on foreign buyers or even domestic buyers, and you're not interested in carrying those receivables. What we'll talk about is ways that you can just sell those receivables. They come off your books, you close them out, it becomes somebody else's problem to collect them. If you're interested in that kind of a structure. A huge advantage of that, of course, is that your DSO can go extremely low. I know a lot of credit managers are measured and even given incentives based on your DSO. And there are even opportunities to make money by offering more financing to a buyer than they might have asked for. You know, if you're familiar with like the history of credit cards, originally they started out as store cards, where people like Sears realized they were making more money on the credit cards than they were on actually selling stuff in the stores. So anyway, like I say, the understanding of the risks in a trade transaction is fairly important in being able to put a structure together. So this is a high-level slide. It's kind of the focus or the starting point in the first day of these 3 one-day classes. So we go through these different risks. These are all things that can happen that prevent payment. So these are the risks of non-payment, and we discuss them so that they you have a full understanding. But at a high level, these are broken into the 3 categories. Excuse me: commercial risk, country risk, so that when you're selling to somebody in another country, that kicks in, and then foreign exchange risk. Excuse me, needed a sip of water there. Foreign exchange risk being a country type of risk, but it's different from the others, so I put it in a separate category. Very briefly here, not to go through all these things in detail, the commercial risks are things that credit managers are typically very familiar with. Financing risk is stuff that you would evaluate based on financial statement analysis. Excuse me. And the contract, and so you have these risks of slow payment and bankruptcy that have to do with cash flow and insolvency. Contract risk is something you evaluate because of comparing notes. The reason you join a group like the Federation is to be able to identify problems that people are having who are in the same industry that you are with buyers. So things like contract repudiation and contract dispute might be a company that has all the creditworthiness you would possibly want. You don't consider them to be a financing risk to give them credit. Gee, the way they treat their suppliers is bad. So you have to gather that kind of information by talking to other people. The political risks, the country risks are divided up into these 2 categories: political risk and transfer risk. The political risks are actually in 2 categories there too. That the first 4 are all the risk that there's going to be some sort of government interference with your buyer in another country being able to pay. And the next 4 are more like the situation in the buyer's country, but doesn't have to do with the government doing something. So like a local insurrection. I mean, you don't worry about this when you're selling to somebody who's in, Georgia or something. You worry about it though when you're selling to somebody who's in Latin America. So if there is a coup, that can be very disruptive to the economy. If there's an invasion and a war, the kind of thing that we're concerned about mainly in the Middle East these days, that can be disruptive. But along the lines of disruption, you also have natural disasters. End of civilization is a particular risk that I put on this chart because when we get to financing, one of the things we talk about is credit insurance. And I'll just give you an idea right now. Credit insurance always has exclusions in it. So there are certain risks that are simply not insured. The big one being disputes. So that if you sell to someone and they claim you did not comply with the contract, it's not a valid receivable, the insurance won't pay. They will only pay if it's a valid and enforceable receivable. But another exclusion that every credit insurance policy, with the exception of Exim Insurance, but all the private insurance companies have an exclusion that says in the event that there's a world war and the major powers are at war with each other, we're not paying any claims. So I call that the end of civilization exclusion. It is a risk. It doesn't typically interfere with your ability to get financing, but it is out there. It does cause the banks some problems when financing trade receivables. Currency inconvertibility is what many people call transfer risk. It's the risk that your buyer simply can't transfer money out of the country, meaning that they have local currency, but they can't convert it into the currency that you're selling in order to pay you. So that's a balance of payments type of thing. And it's an economic risk. And then the foreign exchange risk is the risk that you might be selling in the buyer's currency, and the value of the currency goes down, and so the amount that you can convert that to in your own currency, so presumably everybody on the phone is selling in dollars, the amount that you can convert to in dollars is reduced, and it could even be, of course, to the point where you're losing money. That's the direct risk. An indirect risk, just to mention this, is that if you're selling in dollars, but the value of the buyer's currency goes down, the buyer's going to find that they're going to have to come up with more local currency than they might have planned on, and they might come back to you and tell you that they can't pay the amount that they had originally agreed to pay. So like I said, those are risks. Based on an evaluation of the risks, we do go in, and this is, again, it's the first day of this program we do, we talk about all of the ways to mitigate the risks. But in order to understand that, you have to first determine what terms of sale are you going to agree to. So this is a negotiation between you and a buyer. Now, this is a fairly long list. Usually when you're selling to somebody domestically, the things you look at are either open account or cash in advance. I assume people are pretty familiar with standby letters of credit, so that's a way to kind of shore up an arrangement where you're selling open account, but you've got a third party taking some of the risk out of an open account transaction. But there are a lot of other things on this list. If you're selling capital goods, it's pretty common. So those of you who are selling capital goods are pretty aware of selling on extended terms. So by capital goods, I mean something that the buyer is not going to use and resell, maybe incorporate into another product, or just resell as is or something else. Instead, they're going to, it's like a piece of machinery they're going to use internally to produce other things, or heavy equipment like bulldozers or even trucks and cars and that kind of stuff. In order to sell that kind of equipment, it's very common to have to offer a buyer terms like 3 years, 5 years. The longest that I'm aware of being, I think, 17 years that people are now asking for equipment that is environmentally friendly. So there are certain incentives that governments are offering to offer 17-year financing. But all of these things, like I said, they might be unusual to you otherwise, the ones that are in between for domestic transactions. Most of them can be used domestically, but we see them more in international transactions. So again, in that first day we go through, and I'll talk a little bit about this today, how time drafts work and site drafts. That's what we call documents for collection, what banks call documents for collection. The initials there are documents against acceptance and documents against payment, or CAD is cash against documents. Consignment, and this works obviously domestically pretty well, but there are also ways to do consignment internationally so that you retain title to the goods until you're paid. That gives you an ability to go repossess goods. Depending on countries, if you are looking at this from an international perspective, some countries allow you to repossess the goods that what you sold got incorporated into, and others you lose your right to repossess the goods once those are incorporated into another product. Cash against goods is a structure where you ship the goods themselves like into a warehouse and then release them to the buyer as they pay. Or an international COD is also a cash against goods type of thing, or domestic's the same idea, that you give the goods to a third party, and the third party, so like UPS or Federal Express, agrees to collect payment before they release the goods. And I used to work for ABN AMRO Bank. Maybe some of you all remember them. They used to be one of the largest banks in the world, and we had an international COD program with UPS, where we would receive the payments and notify UPS that payment had been made by a buyer, so that they would get goods as far as the closest staging warehouse. And then once we sent them an email, or it was actually a whole system, but once we sent them a notice that the payment had been received, then they would deliver the goods. So it was an international COD program. And then letters of credit. We'll talk about letters of credit in a little more detail today, just because they have some built-in financing. But these, that's a very good example of something you have to negotiate for. Most of the time these days, buyers are not compelled by local regulations or anything else to give you letters of credit. But based on the competition, based on the credit standing of the buyer and so on, credit managers are going to try and negotiate for the most secure terms you can get. And obviously the ideal is cash in advance, but to be competitive, that might be somewhat difficult to get. Okay, and then the risk mitigation techniques, again, this is in detail on what I was calling the first day. So this is a presentation just on risk mitigation techniques. We talk about what risks a letter of credit covers, whether it's confirmed or unconfirmed, some details about silent confirmation, what that is. I don't know that everybody's even familiar with that concept. Standby letters of credit and the limitations of standby letters of credit. Bank guarantees, so independent or demand guarantees are actually the same thing. At least in the United States, we legally consider those to be the same thing as standby letters of credit. But in other countries, they do these other things that they call, well, they just call them guarantees or bank guarantees. But to the United States, we would call those accessory guarantees or contract guarantees. I'm going to give you some more details, and when we get into the financing, I'll talk about how you use each one of these things to get financing. So I'll explain those structures in that context as well. The documentary collections I was just talking about, so that's your documents against payment and documents against acceptance. The theory of a documentary collection is that the documents that a seller compiles are needed by the buyer in order to claim goods. Now that works best in international transactions, and especially when you're shipping goods by ocean. It's traditional, this goes back hundreds of years, that ocean carriers will not deliver goods until the buyer is able to show them that they have the transport document, which you often call a bill of lading. And it has to have been endorsed and all kinds of stuff to show that they have the title. It's like a check, you know, that you have to give somebody the check, and somebody whoever you gave it to could endorse it, and whoever comes down to the bank with the properly endorsed check gets the money. Here, it's the idea is that you could sell goods to someone who then sells the goods to someone else, and then there's a chain, and that bill of lading actually transfers hands, theoretically anyway, multiple times, and then somebody comes down with the bill of lading to say, hey, those goods are mine, and they claim them. Because carriers continue to allow that, you can use that as a way to control delivery of goods by sending your bill of lading to the buyer's bank instead of directly to the buyer, and giving the bank instructions not to deliver those documents until certain instructions have been followed. So we'll come back and describe more about what those instructions might be. I'll bet people are very familiar with open account. That's probably a very high percentage of your domestic sales, and these days even 80% or more of international sales are done on open account terms. I have these structures here that are really that do get into both risk mitigation and financing, things like factoring that you might think of as a financing structure. You can use it strictly for risk mitigation if that's what you want, but I'm going to give you a little more detail about how that's used for financing. Sale of individual receivables is the same idea, except for that's when you're selling more to a bank. Big distinctions between the way a factor typically works is that they want to buy lots of small receivables on a spread of buyers, where banks like to buy large individual receivables on individual buyers. So you have this similar structure, but two different purposes, two different ways that it works. Then credit insurance, is a way to just mitigate the risk. It's a pure mitigation strategy, but it enables financing. So I want to talk a little bit about that today too. Credit derivatives is something we mentioned just on the first day of the training, and it has to do with accounts receivable puts and credit default swaps. Credit default swaps are really just, very quickly, not a good way to try and manage credit risk. Credit default swaps, accounts receivable puts can be useful, but they're very limited as far as who they're available for. Typically, that would be a domestic type of situation, and you're selling to like a very large, like a big box retailer, and you're concerned that a high percentage of your sales are to Sears or Kmart or Target or whoever, and so you buy a credit an accounts receivable put. So that's not a financing structure; it's a risk mitigation structure. And then for the foreign exchange risks, the ways to manage those are with forwards, futures, and options. We don't have time to really go into a lot of detail on those today, but that would be when you're selling in the foreign currency. You can have your bank or even your stockbroker give you forwards or futures, and then the options are a variation. It's similar to options on stocks and things like that, that you can use to manage the risk of converting payment that you receive in a foreign currency into dollars. It's actually just the bottom line recommendation on that, a quick recommendation, is that it is a better way to avoid risk for you to sell in the buyer's currency than for you to sell in dollars and expect the buyer to have somehow engaged in a hedge, which is what these options and futures and forwards are. Because in a lot of countries they just either won't do it, or actually in some countries they're not available. Some of the Muslim countries actually prohibit it because they consider it a means of gambling. This chart gives you an idea of what risks are mitigated by each of those structures that we just went through. This is kind of what we build up on that first day of the training program. The first 4 categories across the top are the commercial risks. So the first 2 are the financial risks, the next 2 being the contractual risks of dealing with somebody. The next 4 have to do with the political or country risks, and the last one is the foreign exchange risks. So it just helps you understand what risks are already covered once you've negotiated for terms of sale on the left, possibly adding in some risk mitigation already. So I'd like factoring is mentioned there. Forfaiting I'm going to talk about in a minute. It's more of a financing structure. So again, like I say, that's the build-up of those of that first day. The second day of the training very much focuses on letters of credit, so we'll talk a bit about letters of credit here, but it winds up getting into a lot of detail for people who are doing a lot of exporting on letter of credit terms. Okay, so the third day, and this is hopefully you'll be able to pick up a lot of this from today's presentation, even though it's a shortened version, focuses on financing, and we discussed things like, why should you even offer credit terms to foreign buyers? Obviously, a foreign buyer would rather, instead of borrowing money from his bank in order to pay a supplier, would rather have the supplier just give him credit. It looks better on the balance sheet. It might be they don't have any more credit with their banks. Might be that you are offering financing for free. It seems to be a common practice among U.S. companies. So that's cheaper than them borrowing from their banks. And it could be that what they're trying to do is borrow in dollars for some reason, and you as a supplier are selling to them in dollars. Maybe they're going to take the product and re-export it and sell it to somebody in another country and get paid in dollars, and so it's a way for them to hedge their own risks. Or it's very popular, has been at least in the past, for people in high interest rate countries. They like to be paid in a stable currency instead of in their own local currency. And there's also an arbitrage opportunity that that your buyer might have if they can get you to give them credit even if they don't need it. Let's say they're not even borrowing from their local bank. They don't have it. They've got plenty of cash. They have no need to borrow in order to pay you. Yet they might still want credit terms so that they can invest their money, or possibly even dollars that they might be able to invest and earn interest in the meantime. So that's an arbitrage situation where they are making money by getting financing from you. In international transactions, what you need to really understand is that you don't have to give people financing for free. In a domestic sale, it's pretty common, although this is we're seeing some changes, but it's pretty common for people to say, I want 30-day terms, and they agree to pay you at at the end of 30 days. And I believe from like information that the Credit Research Foundation has gathered, that the average terms, that the average DSO that companies have across the United States for their domestic sales is somewhere around 40 or 42 days. So even though 30-day terms are pretty common, I guess most people are either slow payers or maybe there's some people who are getting longer terms. In international transactions, it's pretty common for people to want 90-day terms, 120 days, 180 days. And these days we're even finding for large sales that people are asking for 360-day terms. And in your domestic sales, you might be seeing that there's more pressure to offer longer terms nowadays. There's a big trend in what we call supply chain financing, where buyers are looking at ways to extend the terms that they're receiving and line up ways for you to sell the receivables. That doesn't have to be free. So that's a big message here. You can offer financing, and this works extremely well. If you can offer financing to a buyer, especially a foreign buyer, but maybe even a domestic buyer, at something that looks like your normal cost of funds or your cost of arranging for a third party to finance the transaction, that might still be at a much lower rate than they are used to paying to borrow locally from their own bank. So that might, be a win-win-win, that you get to sell the goods and actually make money by charging more interest than they would normally pay. So they think that's great because it's a low-cost source of financing, and then you sell the receivable and get it off your books and are able to close the transaction out. Okay, if you do offer financing and you don't have somebody who's just going to buy the receivable from you, obviously you're increasing your risks, especially the longer the credit terms you offer. You increase your DSO if you're beyond your average DSO, and in international transactions, like I say, it's often longer terms. And it's going to impact your balance sheet ratios because you yourself are going to have to get cash from someplace else. You're tying your money up in your receivables. And then it is going to increase your costs. You might have to borrow in order to, like I say, maintain operations. And if you are borrowing, there's an indirect cost that your balance sheet ratios can actually cause your interest rates to go up as they, deteriorate is a harsh word, but if your ratios are not as good as they could be, many banks charge what they call grid pricing based on your ratios. But by offering financing, you can increase sales. So there's obviously a lot of pressure from your sales force to offer longer terms. And you might even be in a position to offer longer terms than the competition and thereby drive increased sales. So I want to focus on this to give you something of value in the rest of today's presentation. The idea that if you structure things properly, you can actually decrease your risks, decrease your DSO, decrease your costs, still increase sales, and the way to do that, to get all of that at once, is to structure it in a way that a third party, a bank or somebody else, will just buy the receivable and you can close it out. So, but it depends. Okay, so what are your objectives? So there are a lot of structures that we're going to talk about, and what kind of structure you're interested in is based on your company's situation. If you've got a lot of cash and you're willing to take risks, you might be willing to match any terms anybody else is offering, and you really don't need any third-party financing. You don't need any third-party risk mitigation. So that's a very enviable position for somebody to be in. Most of the tools I'm talking about are unnecessary for you if you're in that category. I used to do some business. I think it's okay to mention their name, but I used to do business with U.S. Robotics. So I don't know if people remember them or not, but at one point in time, they were eventually bought by 3Com, and I'm not sure if 3Com is still independent or if they got bought by somebody else, but U.S. Robotics at one point in time was the largest manufacturer of modems in the United States, and they were making in the world, I think. They were making these fairly cheap modems. Seems like you could get them for 20, 25 bucks. For everybody to hook up to the internet. This was back in the days where you did America Online and dial-up connections, and you had these little modems that you'd have to plug into your computer. and they were making an absolute fortune. They had lots of cash. They were willing to take risks. I went out and visited one time and said, can I talk to your credit manager? And they said, well, we don't really have one. I said, could I take a look at your agings on your accounts receivable? And they said, well, yeah, we could probably get you that, but they actually had to send it to me later because nobody was paying any attention. They had all these receivables that had been on their books for, well over a year. These were supposed to be on 30-day terms. And nobody had ever paid any attention. They kept on shipping to the same buyers, and it was because they were in that situation. They had so much cash, and their margin was so high that they just didn't really pay much attention to the bad credits that they had. They're going to write them off. Their margin was like 98%. I mean, it was huge. They had the money was all in the equipment and the research and all that kind of stuff, not actually making individual modems. Okay, so that's like I say, that's an unusual situation. Let's say you don't have a lot of excess cash, but you need to compete. You're not so worried about risk, but you're just looking for ways to fund your receivables. It is fairly common, and I'm working for Fifth Third Bank, which is a regional bank. We do a lot of asset-based lending to our types of customers, the people that are in our target market. So that's lending where we need collateral. Generally, the collateral would be inventory and receivables. And it's pretty common to exclude the foreign receivables from a borrowing base. What we're going to talk about is specific structures that are just for financing the foreign receivables. If your bank is not offering these to you right now, it could be that your account officer just isn't aware that they're available in the bank, or maybe your bank doesn't offer them. They are a little bit specialized. But we're going to talk about those. Category 3, I need to compete, but I'm concerned about my balance sheet. So I want to get the receivables off my books. So that's a DSO question, closing the receivable out completely. So not just getting rid of the risk, but actually getting rid of the risk and getting the financing all at once. So that's a structure where you sell the receivables. And then I want to expand my exports, but I don't want to increase my risks. So that might be a situation where you have the money, you can carry your own receivables, but you're concerned about the risk and therefore want to find a way to share that risk, like credit insurance being a way to mitigate risk without financing. Okay, from your customer's perspective, whoever you're selling to has got concerns or issues that they're going to deal with as well. Recognize that if you're going to get financing from a third party, or even in a competitive discussion with a customer, if you're selling goods to them and they are going to then use those goods to produce something or sell those on to somebody else, you really don't want to offer them financing beyond when they are going to sell the goods to the next party. So banks look at this as well, and insurance companies and stuff like that. You typically don't want to offer financing for longer than it takes for your customer to generate a cash flow from the goods you've sold. But having said that, as long as you understand what you're doing, there are opportunities to offer that kind of finance and actually make money on it. An example of that situation is that the U.S. government has a program. So some of you who are maybe exporting grain, if anybody on the phone does that, the U.S. government Commodity Credit Corporation has a program where you can get you can offer 3-year financing to buyers of your product if they are outside the United States, and the U.S. government guarantees the payments. And because of the guarantees, banks are fairly open to buying those receivables with an assignment of the guarantee. You take it off your books, the buyer gets 3-year financing on grain that they'll probably turn into a food product in a matter of weeks. So it's a way for them to get dollar financing at a fixed rate for a long time. And people do that. So even though it's, like I say, it violates that first principle. Okay, the buyer does not really want to, if they can avoid it, tie up their credit lines with their own bank. Letters of credit, so if you're asking them to get letters of credit, or to get guaranteed drafts, we call these avalized drafts, or to issue you a promissory note and have it guaranteed, have it avalized, those would tie up their lines with a bank. Or less so than tying up their line with a bank, but just getting them to sign something that acknowledges the debt, becomes a promise to pay, so like a promissory note. That's also something that companies might be a bit leery of, although this one I think is pretty reasonable to expect. And those of you who are selling to Latin America, it's a very common recommendation that you either have the buyer sign a pagaré, which is a kind of promissory note, or accept time drafts that you draw on them. I'll give you some illustrations here in just a few seconds, that become promissory notes. And that's a definite promise to pay a definite amount of money on a definite date and enforceable in court. It's very easy to enforce those types of, these are actually instruments, they're called financial instruments, as opposed to an open account situation where you're trying to enforce a contract. So the customer wants the longest terms they can get. You want the most security you can get, and so you need to negotiate for a trade-off. Bottom line here is just don't give it away. You have a sales, you need to give this guy longer terms. You might say, well, what does he want? He wants 60-day terms, he wants 90-day terms. And the sales guy says, oh yeah, he wants 90. And you say, well, I'll give him 180-day terms if he'll give me a letter of credit. Okay, so that's a potential trade-off. A letter of credit has a vehicle for financing built right into it. Okay, so these are things for you to consider. If you're going to offer terms, where are you getting funded? You know, if it's internal, what's your internal cost of capital? If you have to borrow from a bank, what's it going to cost? Is it going to be on balance sheet or off balance sheet when you get the financing? So off balance sheet being you sell the receivable. Are there any residual risks that you're going to have to worry about? So, you know, like a letter of credit automatically shifts a lot of risk. There's the risk that you get the documents wrong. If you don't have a confirmed letter of credit, you have country risks. So look at, you know, what did you negotiate for, and how can you maybe eliminate the additional risks? And then how much work is involved? A structure that was popular up until the financial crisis was securitization, where you take your entire pool of trade receivables and sell them to a financial subsidiary, and then they would sell those to investors in the marketplace. They would sell the pool, so it would be investments in your pool of receivables. That wound up getting people very low cost funding, but with a lot of work. So there was a lot of time, manpower involved in doing those types of transactions. Okay, so like I mentioned before, it's actually possible to do these structures where you get a DSO of 0, reduced risk, everybody's happy. Here's an example. When we do the class, we actually go through some of these things and as an exercise. So we'll go through the structures and say, okay, here's your scenario, and how would you maybe apply that? So here's an example of that type of exercise. You're exporting, and you're selling to a buyer in Brazil. You've been selling him on net 30-day terms, and that's, you know, he's been paying you on 30 days, in 30 days. But now he wants 180 days. And let's take an average, you know, transaction of $50,000. I'm just throwing that out there. These days, that happens to be about the average size of an export sale. So even though it might sound a little small, I don't know. It depends on what you're selling. But that's about the average size, even though, of course, a lot of transactions are much bigger than that. Okay, if you're thinking in terms of DSO, when you had 30-day terms, you know, by definition on just this one sale, the DSO for that sale is 30 days. The impact on your average receivables is $4,000, $4,167. When you look at your average AR for the year, if you could have gotten net terms or cash up front, your DSO would be 0, and there'd be no average AR. So what this guy's asking you to do is change the DSO for that sale to 180 days, and your average impact on your receivables is going to be half of a year. So it's a $25,000 impact on your average AR for the year. But I've been talking about selling receivables. If you could just sell that receivable and take it off your books, what would happen? Your DSO would go to 0, and your average AR would go to 0. And then the question is, well, gee, what would that cost to do that? Or is there a way I can do that for free? So it costs me nothing, and the buyer is the one who pays all the costs. So I get that, DSO of 0, average AR impact of 0, and a happy buyer because he's got terms, and even though he's paying something for it, he's doing better than if he had to borrow from his local bank. So let's say that in his local bank he's paying 20% per annum, and that would be, believe it or not, a fairly low interest rate in Brazil. So that quote, a prime company, a blue chip company in Brazil. These days, I should check this out, but I understand that companies now are able to borrow at maybe 8 or 10% per annum, but that's a really strong company. It used to be very common for companies to be paying 30, 40, 50% per annum in Brazil. We used to do used car loans when I was at ABN AMRO, where we were charging, I think it was 60% per annum. And credit cards, we would charge 106% per annum. So that was the kind of rates people were used to in Brazil. Anything they can do to avoid borrowing locally is this is an incentive to them to do something else. So here, the buyer is saying, I'd like 180-day terms so that he doesn't have to borrow from his bank, and he's willing to pay you 10% per annum. So for 180-day terms, you might just gross them up by 5% and tell him, I'm going to sell you at this price on 180-day terms versus that price on 30-day terms. And you tell him, and I want, in this particular example, and I want a letter of credit. You know that you call your bank and you say, what's it going to cost to get this confirmed? And so they tell you 0.5% per quarter, which would actually be pretty high for Brazil. So I'm using a lot of conservative numbers here. And they'd be willing to confirm the letter of credit and then to accept the drafts you present under the letter of credit. So this is a guarantee of payment later. Once the letter of credit itself has been fulfilled, they then agree to pay you 180 days later. And the bank is saying they would be willing to do that for 1.5% per annum. That also is fairly high for Brazil these days. And then they're willing to discount it. They'd actually buy the receivable. This is their own risk at this point. So this is your bank saying, I'm guaranteeing the payment, so I'm just going to buy my own promise to pay you. They should be willing to do that at their own cost of funds. And these days, of course, the cost of funds to banks is like 0.5% per annum. LIBOR is extremely low. But let's throw in a high number. Let's say it's 3.5%, which would be much more normal. If we do the math to figure out how this is all going to play out, what you see is that there's a $50,000 invoice gets grossed up by the 5%, so that's $2,500. The letter of credit then that you're going to receive is for $52,500, and the confirmation on that, if you're going to ship within 90 days, so it's 0.5% for the quarter, then you're going to pay a confirmation fee of $262. Whoops, cancel that. I've got something in the way on my screen. All right. Well, anyway, sorry, I couldn't move it out of the way. That there's an acceptance commission that the bank charges. The 1.5% per annum is the $393.75, and then the acceptance, the actual discount charge for buying the receivable, like I say, is $900. So what you do get here is that the net of the whole thing is that you had a $50,000 sale that you would have waited 30 days to get paid. Even after paying all these other charges, you still collect $50,925. The importer got the financing he was looking for. The bank that you're arranging this with is taking 100% of the risk with a letter of credit because they're confirming it. You're getting paid immediately, so you've actually cut your DSO down from 30 days to 0. And you've made an extra $900 by putting the structure together. Now that's just one sale, so you could replicate this, and I've worked with companies who've done this over and over again and make a lot of money on the side, by offering financing, and yet it's off the balance sheet. Okay, so back to how your company views financing. If you have lots of cash, you have alternatives, you can do the kind of thing I'm talking about and just carry it internally if you're not worried about a balance sheet impact or the risks. You can just make money by offering longer financing. You could also use the receivable as collateral in order to borrow. Again, there are still some special programs for borrowing against foreign receivables that you need to know about. You can sell the receivable, and that's the one we were looking at on the previous slide, so that takes care of both the risk and the financing at once. So those are the basic three alternatives. Which one of those are you trying to accomplish? So let's go. This is going to be a quick overview of some of these structures. These are built on these principles: security interest laws, true sale accounting, so if you want to get it off your books. Negotiable instruments are extremely useful in international transactions. They're actually very useful domestically too, just people don't seem to use them much. Letters of credit, and that's both commercial and standby. Credit insurance, and ECA stands for Export Credit Agency. The one that's been in the news a lot lately is the Ex-Im Bank here in the United States, so they're an example of an export credit agency. Their purpose is to encourage exporting by shifting risks. Okay, so this is a list in this 3-day program. We go through all those bullets should have lined up, so something happened. There's no reason some are indented and others are not. We go through all these different things in that 1-day program. How bank guarantees work and what kind of financing is available with them. What kind of financing is available if the buyer will at least sign a promise to pay, or what you can do is in terms of financing if it's open account. Buyer's not signing anything except for a contract, and then some of these specialized programs. The bullets are there just next to these to say which ones are non-recourse types of financing, so you can get it off your books. Limited recourse financing is typically something you can get off your books. It might be you can only get a percentage off your books, but it depends, do you care? But there are a lot of, you have to get an accounting opinion for the ones that are limited recourse. And the ones that are full recourse are just a way to get financing. You have to leave it on your books, and you have to show it as bank debt when you do those types of transactions. So the first group being the bank guarantees. Letters of credit are a big example of this. So here's a commercial letter of credit. A commercial letter of credit being that the letter of credit is intended as the means of payment, and that's as opposed to a standby letter of credit, which is not intended to be paid, but is there as an assurance of payment in the event that you don't get paid the normal way. So this is a diagram. I mean, like I say, we go through this on the first day, and we revisit this in real detail on that second day to talk about how international letters of credit work. Briefly, and I'll bet people have a basic concept of this. When you get a letter of credit, what you have is your buyer has to go to their bank and ask their bank to issue a letter of credit. It would be delivered through a bank called an advising bank, so that's what's on this diagram. That bank has no responsibility in the transaction except to verify that the letter of credit's authentic. And then you as the seller can take the risk of the buyer's bank now. As long as you can present the documents the letter of credit calls for, the bank is obligated to pay you. So you've shifted the risk from your buyer to their bank, and you present your documents. One of the big things we talk about on the second day is how to present documents to your own bank. So structure these things so that you don't have to worry about going back to the advising bank, who's really a correspondent of the issuing bank. Okay, and then you collect the payment. The crux of the matter here is shipping the goods and generating documents that the letter of credit calls for, so you can present those and obligate the issuing bank to pay. If you're concerned about country risks, you would ask for the issuing bank to name a confirming bank. There are problems with confirming banks that we explain in these sessions, but generally what you're looking for here is you've shifted the risk from the issuing bank to the confirming bank, and if the confirming bank's in another country, then you've hopefully taken care of all the country risks. Silent confirmation is a variation on the first structure. So you've got a letter of credit, you've made sure you actually can present documents to your own bank, and you ask your bank for a commitment that they will buy the documents without recourse. So it's a sale of a receivable based on the fact you've got a letter of credit, and then the bank cashes you out when you ship, and they take the risk. We call it a silent confirmation. It's not really a confirmation at all, but it accomplishes the same risk mitigation, and it arranges for the financing up front so that they've bought the receivable. many buyers will want the letter of credit to actually be a time letter of credit. So instead of a letter of credit that's payable immediately, the letter of credit says it's payable some set time after the date of shipment, or some set time after the date of the invoice, or some date after what we call sight, which would be the presentation of the documents. That is a very common structure with letters of credit. So you build the financing in, but you can sell that receivable, even though it's on a time draft, sell that receivable to your bank up front, take it off your books, no more recourse, 100% covered. Just make sure your sale price covers the costs, and you're coming out ahead. Okay, in the class we go through some of this stuff too, subtle variations. What's the difference between a letter of credit that calls for time drafts and one that calls for a deferred payment? So this is kind of technical stuff, but just to give you, again, a flavor for the class. And then if all you need is financing, some banks, although you really have to ask because this is not a common thing, most banks will do this, it's just that they don't have many customers who seem to be interested. But you could ask a bank just to advance you the money on your letters of credit, and you continue to take the risk of the issuing bank. This is an unconfirmed type of letter of credit. So this is treating letters of credit like checks. So you deposit documents with your bank, they go ahead and give you the money, they try to collect from the issuing bank. If the issuing bank doesn't pay for some reason, then they charge you back. Very, very common in Asia, but for whatever reasons, this is not something that many people want in the United States. In any event, no matter what you're going to do, you should ask for what we call freely available letters of credit. And if you have discrepancies, again, we talk a lot about letters of credit on the second day and how to avoid discrepancies. But the fact of the matter is, over 80% of the documents presented under letters of credit, or around 80%, have discrepancies. They don't comply. And yet only about it's actually only about 3 out of 10,000 don't get paid. So if you're willing to take the risk of payment, you might give your bank an indemnity in order to get paid right away. Moving on, this is another kind of guarantee. This would be, instead of a letter of credit, this is that documents against acceptance structure. You send the documents the buyer needs to their bank and ask the bank not to release those documents unless they guarantee the payment at the maturity date. So as opposed to a letter of credit, there's no engagement up front, but at the time you present your documents, your buyer is supposed to get their bank to add this guarantee, so that's called an aval. There's actually this piece of paper called a draft it's a promissory note, and you can sell that. When you take those negotiable instruments and sell them, that's called forfaiting. So if you've ever heard that term before, and forfaiters buy these with no recourse. They take the risk of being able to collect from the guarantor bank. So that's a forfaiting structure. It's a non-recourse. So like I say, the green and the red are full and non-recourse. The documents against payment and documents against acceptance there's no bank engagement in these things, but there's the buyer at least is signing a promissory note. So you've got something in a time draft situation. He signs something that you could take to court and sue for payment. So your instructions to the bank are deliver documents against acceptance of the draft. You can get insurance on those. It's actually, well, for some reason, most credit insurance policies exclude, as just normal standard terms, they exclude letters of credit and time drafts. I would recommend adding time drafts back in. Most of the insurance companies have no trouble with that. They just, for whatever reason, assume you don't want it, so they exclude it. But you can insure those acceptances so that instead of having a bank guarantee it, there's a credit insurance company taking part of the risk. Export bills financing is also, it's another thing that's very common in Asia. You could do it with some banks in the United States, and it's just where you're borrowing on your receivables, but these are receivables where you actually have accepted drafts, so they're a bit better in terms of at least having the buyer, what we call approving the payment. This is what we nowadays call supply chain financing, but that's for international transactions. It's often called export bills financing. Okay, in open account situations, the buyer's not signing anything. A bank is not, issuing something on behalf of the buyer up front. So we have a lot of structures here that are limited recourse or full recourse, but there's nothing here that's actually completely off the books, except for maybe getting an accounting opinion. Credit insurance is something that's very, very common for open account sales. You share the risk on an insurance type of arrangement. You don't get 100% coverage, so it's pretty common to get this. This example is 90%, and this is saying if you're getting credit insurance and you're interested in financing, it's very important up front to get your insurance policy written so that it encourages a bank to either lend against or buy your receivables, and ideally in this one we're trying to maximize what we call eligible receivables. A lot of banks will include your foreign receivables if you have credit insurance. Some banks have been burned. What they need to do is pay attention to how your insurance reads. What the bank should want is what we call a cancelable limits policy that's risk attaching, maximizes the percentage of coverage, and covers as many buyers, the buyers that you want to cover. That they're the amount that they would finance would only be the amount that you're covered for. If there's a policy limit, then obviously that would be the maximum that the bank is going to finance. So the higher the limit, the higher your financing need, the higher you get that to be. So that's, like I say, that's an example of getting credit insurance of the type that facilitates financing. We go through this in a lot of detail in the class, but there's it might sound like, in particular, cancelable limits might sound bad compared to non-cancelable limits, but the fact is that a policy with non-cancelable limits puts more responsibility on the insured, which might sound good to you if you're the insured, but doesn't sound more good to a bank who's providing the financing. They'd rather that the responsibility for monitoring the creditworthiness of buyers be held by the insurance company. So anyway, so that's, like I said, there are a lot of things that you can vary depending on what you're trying to accomplish with credit insurance, but that's if you're trying to get financing. When you do have a credit insurance policy, you would add individual buyers, not transactions, but individual buyers to the policy. And if you're going to get financing, you make your bank the loss payee on the policy, and they give you a in this one I'm saying a receivable purchase agreement. That could be they're just going to lend, but a number of banks these days will actually buy the receivables based on the fact that you've got insurance, and then have limited recourse back to you in the event that what happens is you ship the goods, they've bought the receivable, and then you don't get paid. If the payment doesn't come in, and the banks will monitor this, typically they ask you to open up a controlled disbursement account at the bank, so they see the payments as they come in, and if one of them goes past due or significantly past due, they'll tell you, yeah, okay, you need to claim on the insurance, and then they get paid out on the insurance settlement. So they've got the insurance out there. Banks will consider that to be their primary risk as opposed to having to evaluate the risk of all the individual buyers. The credit insurer evaluates the risk of all the individual buyers. Factoring, I think, is something that people have a general idea of. If you're going to factor international transactions, you would ask your factor to enter a factor's chain. Your factor becomes what we call the export factor, and they find a factor in the country of the buyer who's willing to take the risk of the buyer. Looks very similar to how letters of credit work. You have a bank taking the risk of the buyer and another bank taking the risk of the other bank, the one that's taking the buyer. So it's a chain. The big difference between this and letters of credit is that the buyer never asked for the factoring to take place. So there's no reimbursement agreement between the buyer and that import factor. You sell the goods, you sell the receivables. In domestic factoring, it's common that you sell receivables with recourse, so it's almost like just borrowing, like using them as collateral. But in international factoring, typically the factor takes the risk of collecting, so they actually do the collection as well as taking the risk of non-payment. And that's based on the fact that they're getting another factor involved in the transaction. So they go ahead and cash you out. They might build up a what they call a reserve for what they call dilutions, so that there will be occasional disputes, invoice adjustments, rebates, other stuff. So they'll set that up as a pool that they can make adjustments from. And then the import factor collects the invoice, doesn't actually buy the receivable, but they try and collect the invoice, and they pay the funds when collected to the export factor, who then closes out the loan, actually to close out the receivable because it's theirs now. And if they've collected more than they advanced, then they give you the rest. Okay, bankers' acceptances, I'm going to skip through this for the sake of time. It's just a vehicle for obtaining financing. It happens to have some preferential treatment in U.S. regulations that you can borrow using bankers' acceptances. You can borrow from a bank at a fixed rate that is typically below LIBOR. But these days, LIBOR is so low, this just doesn't mean anything to anybody. The drawback on an acceptance is, it's like the letters of credit that we were talking about before. You have these time drafts and they have acceptances. This is one where there is no letter of credit, but you're doing time drafts drawn on your buyers and you're selling them, but they're fixed rate, fixed term. And maybe that's good, maybe it's not. In a high interest rate environment, it's much more popular than it is these days. But you would have your bank take, accept drafts you draw on the bank as opposed to drawing drafts on your buyer. And as the bank accepts them, you sell them to investors, and when the receivable gets paid, it gets paid to the bank, who pays off the investors. It's kind of a poor man's securitization program. It's a way to get a bank just involved as a guarantor and yet access funding in the investment market. And like I say, it traditionally has been very cheap because everybody knows that it's based on trade transactions, and trade transactions get paid. Okay, and asset-based borrowing, I don't have any slides on this in particular, but just asset-based borrowing is including these international receivables in your borrowing base. Structured programs, again, I'll just go through these quickly, but we'll see what kind of questions people might have. The big things are the government guarantee, the ECA types of programs. If you need money in order to produce goods, the only ways to do that, banks don't usually like to lend you money to produce goods. They'd rather just lend you the money. They just call it working capital. If you're borrowing money specifically to produce goods for export, there are programs available from EXIM and the SBA. And then there are some programs post-export as well. So a big one from EXIM, they are back in business now, is that you need the working capital in order to produce the goods, so they give a guarantee not to you, but they give a guarantee to your bank if they will provide financing to you in order to produce goods. There's a limit. They're required to maintain collateral, and only 60% of the collateral can be inventory. The rest has to be receivables. The bank is allowed to make a 75% advance on the inventory and a 90% advance on the receivables. There are a number of other restrictions and things that you have to look at when you do these programs. SBA is a little different, but very, very similar. If anybody on the phone is already using an SBA working capital program, the export working capital program is much more liberal. It has higher advance rates. It's trying to match what you get on the EXIM program, so that doesn't make a great deal of difference whether you use the SBA or EXIM. And as a matter of fact, they are being co-marketed now, so that SBA people are selling the EXIM program and EXIM people are selling the SBA program. Big difference is that the EXIM program, EXIM is only allowed to finance U.S. exports, so that means the goods themselves have to be U.S., and SBA is not worried about that. This is a slide, I stole this from an EXIM website that just shows you how without a working capital guarantee you might be able to borrow $760,000 based on inventory and receivables, but with a working capital guarantee you can more than double the amount that's eligible for borrowing. One thing to realize here though is the big thing here is inventory. Banks will do programs where they will lend against your foreign receivables, but the banks don't like to lend against inventory that's destined for export. Purchase order financing. This is something that's a very specialized area. You have a purchase order and you need financing to produce the goods. Very, very few companies will lend you the money in order to do that, and the ones that will do it are typically finance companies. The interest rates are really, really high, and they really don't even want you to be involved in the transaction. They want to know who you're buying the goods from, so they want you to get finished goods from somebody else, and all you act as is an intermediary. Ex-im insurance, and then post-export loans. Also, these are also, like I said, government programs. I've put up some of the information here, but ex-im does facilitate financing if you get them involved in your export transactions. You can also, ex-im does medium-term types of stuff that's harder to get, medium-term insurance. But that's, some insurance is available from private insurance companies as well, especially short-term. But when you get beyond 5 years, most private companies don't really like to go beyond 5 years, and ex-im winds up being the only game. So they start looking at, when you go into these long-term, medium and long-term sales, ex-im's requirements get stricter. For example, you have to actually ship the goods from the U.S. They don't have to be just U.S. goods, but you have to actually ship them from the U.S. And then for long-term transactions or for large transactions, so there's a dollar amount, you have to actually use U.S. vessels. And believe it or not, there are not very many vessels that are U.S. flag vessels. Most of the vessels are like, the Bahamas and Panama, things like that. So that's the list here. Like I said, I kind of whipped through it. It's a something that's kind of suitable for one day, but hopefully people have gotten something out of this. Again, revisiting that idea of why do you need the financing? So this is talking about financing. Why do you need it? Do you need it because you need money in order to produce the goods? Do you need it because you're trying to just look for ways to finance, medium-term, short-term receivables up to 180 days? We call it short-term. Or are you in need of medium-term financing? So these are the same structures we just looked at, just arranged according to what your need might be. And then depending on whether you want to do it on or off balance sheet, you have the non-recourse, limited recourse, and full recourse indications there. This type of financing I'm talking about, so export funding, is available not just from commercial banks, but from other parties as well. I mentioned before that your lender might not even be aware. So whoever you talk to might not be aware that there's a trade finance department. So if your asset-based lending group, if that's who you're borrowing from, tells you, gee, they won't include the foreign receivables in your borrowing base, you might ask, do you have a trade finance department? Maybe I can look at ways to pull those receivables out and finance them completely separately. And then the securitization department might be, again, a third alternative, although we didn't really talk about securitizations today. But I mentioned those can be pretty expensive to operate, but they wind up being really, really low cost. These days, because interest rates are so low, as well as the problems people have with securitizations in the financial crisis, those are not so popular. Factors, obviously, are the ones who do the factoring. Finance companies, like I said, do some of the the pre-export financing. Hedge funds these days are coming into the game because they're looking at this as, I haven't gotten into this too much, but banks are being required under new regulations to maintain a lot more capital to support all of the loans they do. And the what used to be very preferential treatment that was given to some forms of export financing is not just going away, but it's actually the capital requirements are being jacked up. Believe it or not, banks are being required to have 7.5 times as much capital for transactions involving emerging market countries, which means they have to charge 7.5 times as much. So if they used to charge 1% over LIBOR, now they're going to have to charge 7.5% over LIBOR. So these are getting really expensive for banks. And yet the risks are considered very low. So hedge funds are looking at these things as a way to make a lot of money on a low risk. Forfeitors specialize in those negotiable instruments. And then in some cases, the export credit agencies can even provide financing. Okay, I've used up almost my entire allotment, but if there are questions, I'm certainly still available. See if I see any that have been posted as we've talked. Okay, I don't see any showing up on my screen. Hello? Justin, how do we work the questions here? Hello? Hmm. Hello?
Hey everyone, it looks like we got dropped from the audio. So as I was saying, I guess you guys could not hear us, but thank you, Buddy, for taking the time out to present, and thank you all for taking the time to join us for today's presentation. If you do have any questions, you can feel free to pose them in the questions function on your side panel, and we'll get to them right now. If you do have any other questions and have to run, I know we're a little bit over on time, you can feel free to reach out to us directly, and we'll pass those questions along to Buddy. Buddy, we do have a couple questions in here already. The first question is, if the bank takes the discounted letter of credit, will the exporter have the liability if the documentation does not meet the LC requirements?
I wonder if he dropped.
All right, so what I'm hearing from the audience is that it looks like our speaker dropped while we were dropped on the presentation. So what we're going to do is we do have a couple of questions in here, so I will pass those along to Buddy so that he can address those questions accordingly, and we'll get them, all those answers out to you guys. So thank you again.
I dialed back in. I don't know if there were any questions pending, but
hey,
I had to drop off and dial back in.
All right, we do have a couple of questions here if you want to get to them currently. The first question we have is, if the bank takes the discounted letter of credit, will the exporter have the ability or the liability if the documentation does not meet the LC requirements?
Yeah, I guess the order there is that a bank will not buy your receivable, at least without recourse, unless you present documents that do comply with the letter of credit. So that's the first thing, is make sure your documents are going to comply when you get the letter of credit. Read it and make sure you know what the requirements are. So the commitment, whether it's a silent confirmation or a regular confirmation or anything else, the bank is committing to buy your documents or buy your receivable only if the documents comply, at least in terms of non-recourse. Like I was mentioning, there are some banks who, and you can ask, banks are generally not averse to this. Banks will buy your documents with recourse when you have discrepancies if you want, but it just means that if the documents get refused, they'll charge you back. The nice thing about letters of credit is that they find out within a matter of days if the documents are being refused. So if you have a 180-day term on your letter of credit, it's going to be up front. The bank's going to find out like within a matter of 10 days, 2 weeks, if there's a problem. So if you do have discrepancies, it's very, very possible to have the bank, your bank, contact the foreign bank, get the discrepancies waived, and after the discrepancies are waived, to have your bank buy the receivable without recourse.
All right, great. The next question that we have is, what would you say would be the biggest takeaway from this presentation, if you could give one piece of advice or something people should keep in mind?
Yeah, I mean, the big thing about trade finance or financing export sales is if you want to do it, if you're trying to finance your receivables, whether it's getting them off your books or just getting financing, be sure up front that you're negotiating the right structure that's going to make the financing possible. I can't tell you how many times I've gotten calls from exporters saying, I have this receivable and I'm trying to figure out a way to finance it. And you look at it and you say, well, it's just all structured wrong. You know, there were probably some things you could have done just a little bit differently, and I could have financed it. Call your bank up front. I mean, the bankers, like myself, I'm a trade finance person. The bankers are really very happy to explain to you how to structure these transactions so you can get financing. Try and do as much as you can with the bank you have a relationship with.
All right, great. It looks like that's all of the questions we have. If anyone does have any questions, like I said, you can feel free to reach out to Buddy or to us directly, and we will pass them along. I know we have a couple more coming in here, so I'll have Buddy reach out to you guys directly so that we don't take up any more time. Thank you guys again for bearing with us today, and I hope you guys have a great rest of your day.
Thanks, buddy.
You're welcome, and happy holidays to everybody.
Too. Be on the phone for another